The global economy is on a knife's edge. Trade wars are erupting across continents. Donald Trump is clashing with the world's richest man. And supply chains? They're being torn apart in real time. But today, amidst all this chaos, India just made a bold move that could quietly change everything. The Reserve Bank of India slashed the repo rate by 50 basis points, bringing it down to 5.5%, a decision that could put real money back into your hands. Let's break it down. The RBI is like the bank for banks. When commercial banks need short-term funds, they borrow from the RBI. And the interest they pay is called the repo rate. So when that rate drops, borrowing becomes cheaper for banks. And those savings pass down to people like you. Cheaper home loans, cheaper car loans, more business credit. Today's cut, a full 0.5%, is one of the biggest in recent years. And it didn't come out of nowhere. It came at a very specific moment. India's economy has been losing steam. Our GDP growth has slowed to just 6.2%, down from the 8% highs we saw not long ago. Globally, it's worse. The IMF recently downgraded global growth to just 2.8%. But here's what gave the RBI the confidence to cut. Inflation is under control. After sitting above the RBI's tolerance band in October 2024, inflation has now cooled dramatically, falling to just 3.2% in April. And the RBI expects it to remain well-behaved, forecasting an average of 3.7% for this year. That's comfortably below the RBI's 4% target. With inflation this low, the central bank has breathing room to revive the economy without risking a surge in prices. And now, it gets personal. If you're paying off a 50 lakh rupee home loan, this cut could slash your EMI by around 1,500 rupees. That's nearly 18,000 rupees saved every single year. For small businesses, this could be your moment. Loan rates for MSMEs are expected to dip below 10% or a level not seen in years. But there's another side to the story. If you're a saver, especially a retiree relying on fixed deposits, this news isn't so welcome. Fixed deposit rates, which were above 7% just 2 years ago, have now dropped to around 6 to 6.7% at most banks. For pensioners and retirees who rely on FDs, that decline means losing thousands in interest income every year. So what's the alternative? Debt mutual funds are currently yielding around 6.5%, offering a decent balance of returns and safety. Government bonds remain a safer choice, though their returns tend to be a bit lower. For those ready to face market ups and downs, the stock market could provide higher gains. But keep in mind, the Nifty has seen swings as high as 18% this year, so it's not for the faint-hearted. High risk, high reward, but high volatility, too. Now, zoom out. While the US and China play economic tug-of-war, India is quietly positioning itself as a global favorite. In the past year, India attracted over $65 billion in foreign investment, flowing into sectors like technology, infrastructure, manufacturing, and green energy, highlighting the country's growing appeal as a global investment destination. This repo rate cut isn't just about money. It's about sending a message. India is stable. India is responsive. India is ready. And in today's unpredictable economy, staying still might be the biggest risk of all. So, if you're carrying debt, this might be your breather. If you're a saver, it's time to rethink. And if you're an investor, there's opportunity. But it won't wait forever. Let us know. Are you celebrating the rate cut or worrying about your savings? And if you found this breakdown helpful, tap like and subscribe. Up next, one of 2025's biggest money questions: Bitcoin or gold? Where should you put your money? Stay tuned, you don't want to miss it.